Hey guys, welcome back to Money Talks. In case you're new here, my name is Ian. Today I want to talk about this fintech service called Worthy Bonds. They've been around for just maybe a year or two, and it's really cool. It's a peer-to-peer lending service. Kind of like if you think about, there's one company, I can't remember, they're really big. I mean, they're still big. I can't remember. Anyway, it's a peer-to-peer lending service. They offer what they like to call bonds. I'm not sure if they're technically bonds. They're mostly just micro loans. Each one of them is $10. So you buy them in $10 increments, and they earn an interest of 5% APY, 5% annual return over the course of a year. Let me just go to their website here and I'll show you what I'm talking about. So here's their website right here. As you can see, we have a 5% interest rate. You can buy them in increments of $10. And basically what these are, it's a peer-to-peer lending service. So we have us, the investors, buying a $10 bond, and Worthy goes out and small businesses can borrow that money, basically. And the return obviously here is a lot higher. It's a lot higher than any savings account. Obviously less than the stock market, but comparable to what you'd expect for maybe corporate bonds or some municipal bonds. So as we can see here, they're helping small businesses, which is always good. It's really cool that we can connect consumers like you and I, retail investors, with directly with small businesses through this service. And then as you can see here, we got our kind of our summary: 5% interest, minimum investment of $10. You can withdraw your cash anytime, which is always cool and really important for me. And then if you want to see how much your investment can earn, you can check here. So if we put $1,000 in here and we leave it in for 3 years, that was $20,000. Let's say, okay. If we put in $3,000, we're earning $4,500 over three. We're earning $450 over 3 years. And then down here we have our risk profile. This is good to see. So Worthy bonds are secured by assets, by physical assets that exceed the value of the bond. So they can be secured by inventory, real estate, equipment, whatever the business owns, the bonds are secured by. So it's not like they're just lending money to Joe Schmo's flower shop down the street and he doesn't even have a storefront yet. It's they've definitely done their homework here, and they're vetting the companies that they are lending money out to. So that makes me feel good about this. And as I said earlier, it's really cool to see that we can connect retail investors with small businesses almost directly. I mean, Worthy's the middleman here, but it seems like it's a lot more, seems like there's a lot fewer intermediaries here. And obviously the return is very good. And you always have to remember, with a higher return, there's higher risk associated with that. So this isn't guaranteed like a savings account, but I would be willing to bet that it's the income, the dividends from this is, and the earnings are more stable than the stock market. So let me just go into my account here. As you can see, I've earned 91 cents of interest. That's with 7 bonds that I've bought every month over the past 7 months. And then we have 7 bonds, that's $70, and then 91 cents plus $70 is $70.91, my portfolio value. And then I have a recurring investment here. I buy one bond every month on the 24th. And then let's just look over here. I got my automatic reinvestment enabled. And then, yeah, that's about it. So it's really cool. Oh, and right here, if you're interested in the service, go down to the description. Use my referral link. It really helps the channel out. If you feel like helping me out and you like this service, be sure to use the referral link because it helps me out a little bit. It keeps the lights on here and the mic's hot. So I'll put that down in the description. So I said something earlier about corporate bonds. So corporate bonds are typically in the range of 2 to 3%. So this is a lot higher than corporate bonds. This is in the territory of junk bonds, which makes it sound bad, but junk bonds are just higher risk bonds, and they typically have a higher yield because with higher risk comes higher reward. So these are in the realm of junk bonds, but don't get turned off because of the way. Don't get turned off by the word junk. So Worthy Bonds kind of operates similar to Lending Club, which was a lot bigger in the early 2010s. And Lending Club, I'm not sure if they're still around anymore, but they had a big problem where they lent to companies or they made personal loans that didn't have any backing. They were completely unsecured, and I don't think Lending Club has done that well. In fact, I'm not even sure if they're around anymore, but I know their rates were really high because the loans they gave out were extremely risky. We're talking 20% interest loans. So if you were lending that out, you got that 20% return, but I mean, the risk was just so much higher. The risk of default was a lot higher. So I would definitely say Worthy Bonds is it's a lot safer than Lending Club. Still not 100% safe. Worthy Bonds aren't insured, so there's always going to be some risk there when you're not insured there, like an FDIC insured savings account. So basically, because they're under Regulation A+, there's less governmental oversight of these kind of financial instruments, so there's less protection for investors. So the key risk factor here is just the reliability of the vendor, Worthy Bonds. And there's really no way to evaluate that except looking at how they vet the companies that they lend money out to, as we saw earlier with the making sure that the loan is secured against something. For example, like they said earlier, they only lend to companies that have assets that the loan can be secured against, like inventory, equipment, or real estate. So for example, if I own a bakery and I have a $20,000 oven in the back, and I can possibly take out a $15,000 loan because that loan is secured with that oven that's $20,000. So the oven's worth more than the loan. So Worthy has made sure that if that bakery goes under, they have that security there. Think about it this way: a credit card is an unsecured line of credit, essentially, because there's nothing backing it. That's why you have that higher interest rate. Same goes with a personal loan. You typically have 6, 7, 8, 9, 10% interest rate on a personal loan simply because it's unsecured. Whereas an automotive loan, a vehicle loan, is secured because you have the car there that it's an asset that can be repossessed. So that's why a car loan, you might have 4, 5, or 6% interest rate. Same goes for a house. Houses obviously go up in value too, so the banks can offer even lower interest rates on that because it's secured and it's an appreciating asset, as opposed to a car, which is a depreciating asset.